Hello, this is Dean Kernut, and welcome to the Alpha Exchange, where we explore topics in financial markets associated with managing risk, generating return, and the deployment of capital in the alternative investment industry. In Lori Calvasina's role as head of U.S. equity strategy at RBC Capital Markets, assessing the interaction between macro variables like rates with top-down factors like the equity market multiple is critical. But important as well is an evaluation of markets from the bottoms up. And here, she not only seeks to pull together the views of colleagues doing strategy work in sector verticals, but also to actually read earnings transcripts during reporting season to get a sense of what companies are saying. Her broad assessment of the outlook for corporate America is generally optimistic, as she sees companies having come out of multiple stress exercises, trade wars, the COVID shock, and the inflation and monetary policy response in the pandemic's aftermath among them, with a stronger defensive plan. Companies are harnessing technology and managing costs more effectively, leaving them less likely to be forced to reduce headcount. The result is a consumer holding up quite well. Our discussion touches on the Mag 7 and how today's top-heavy portion of the market is similar and different to the high flyers of the tech bubble. For Lori, the valuation premium for names like NVIDIA and other mega-cap tech stocks is justified by the premium of earnings growth they've been able to consistently deliver. We explore the impact of higher rates on the market's multiple and the relative performance of sectors as rates rise or fall. She likes energy, both for its high dividend yield, its strong relative performance as rates rise, and the potential for a geopolitical tailwind. On this last front, asked about the market risks that she worries about most, is uncertainty on the global political front, along with the U.S. election. She cites as well sentiment that may be too bullish and positioning that appears stretched. Lastly, we touch on Lori's recent recognition as one of Barron's top 100 most influential women in U.S. finance. Asked about the industry efforts to empower female careers in markets, she's optimistic, arguing that it's critical to have not just a mentor, but a sponsor as well to push you to the next level. I hope you enjoy this episode of the Alpha Exchange, my conversation with Lori Calvasina. My guest today on the Alpha Exchange is Lori Calvasina. She is the head of U.S. equity strategy at RBC Capital Markets. Lori, it's great to have you on the podcast today.
Thanks for having me. It's great to be here.
I am looking forward to the conversation and an exploration of your process and what you observe in this wonderful world of asset prices and what the implications are for investors. Let's get our conversation underway and learn a little bit more about you and your career history. Tell us about how you got started in finance and take us through how you got to become the head of U.S. equity strategy at RBC.
It's hopefully what I think is an interesting story. I would describe myself as an accidental strategist. So I grew up down in Alabama. My dad was a business professor. It had nothing to do with finance. It was more managerial. And I was always dead set on not going into the business world. So made my way up to the University of Virginia, studied political science, was in what at the time called the Government and Foreign Affairs Honors Program. And I really wanted to do a PhD in political theory. That was where I thought I was headed. And at one point in my major program, we were allowed to audit classes. And they tended to be graduate classes. We wouldn't get grades, but they really tried to encourage us to go out and explore different things. And I ended up in a class with a professor named Ed Burton. I think it was called Theories of Financial Markets or something along those lines. And he talked me into taking a look at Wall Street. And my senior year, we called it fourth year there, set me up with some interviews. I remember talking to one hedge fund, talking to someone in fixed income at Lehman, and then eventually talked to the strategist over at what was then Smith Barney. I think Citi had just bought them. He ended up offering me a job. And so after college, made my way that summer to New York City, dropped my car off at a relative's, moved in with some other relatives for a few months. And I've been doing equity strategy ever since. So I did it at Citi for a number of years, ended up working for Tobias Levkovich, who had been the longtime strategist there. Worked for him for about 7 years. And then one day he looked at me and he said, the person who was the small cap strategist at the time was retiring. And he said, Bert's retiring. Do you want to be the small cap strategist? And I said, I guess. I didn't know that much about small cap at the time and ended up taking a look. And I got married and I said, can we wait till after I'm married? And he said, sure. So we waited till after the wedding. I launched on small cap in 2007, hung out at Citi for a few more years. made my way over to Credit Suisse as a small cap strategist, and then made my way over to RBC in 2017. My time at Credit Suisse, I started morphing from being a small cap strategist to covering the broader equity market again. And over at RBC, I'm the only equity strategist. So we cover the S&P 500, Russell 2000. I do a lot of work on sectors and work really closely with other strategists in derivatives, fixed income, FX. And that's probably one of the things I pride myself on. I've done this a long time. I know a lot of analysts around the street, a lot of macro people. And I really do view my job, one, to make calls, but also to be a little bit of a diplomat and to try to pull the views of the group I'm working with together into one cohesive view.
Well, you mentioned 2007 and then 2017. So I live and breathe the VIX as part of my process. And at least at the very early part of 2007, you had a VIX dip below 10. And then in 2017, it spent a lot of time below 10. And both those periods for the next year, market blew up in some ways. One of the things that I think is consistent among us all in markets is that we're some byproduct of our experiences. And so I was just hoping to have you reflect back a little bit. You've been doing this for quite a while, and we see these market cycles, these financial cycles, cycles of monetary policy. If you're to think back on the types of experiences or the interaction with folks like Tobias, who I had the pleasure of meeting, and sadly we lost him, what are the people or the experiences that have been influential in helping you develop your framework, your mosaic for thinking about markets?
I think Tobias obviously had an enormous influence on me. At the time I started at Citi, he was not the strategist, but he took over about a year or so after I was there. And I hung around and continued to work for him, as well as the outgoing strategist at one point in time. I was working for both of them, which was interesting. But at any rate, he had been an industrial analyst. And so I think that's one of the reasons why I tend to stay so close and listen so much to the analysts I work with, because he always had his ear to the ground with the analyst community and brought his industrial experience into the role. One thing people will say about me is I'm a bottom-up, top-down person, but I think I definitely got my inspiration for doing that from him, and really not running the higher level macro models. But one of the things we do on my team, I have a couple of associates, and we divide up the S&P 500 in earnings season, and we read transcripts because I want to see what the companies are talking about. I want to see what the companies are saying. I think that bottom-up approach I very much got from him. I think the other thing I got from him was probably he had no filter sometimes, and he would just go out and tell people what he thought they needed to hear, not what they wanted to hear. And sometimes that made him popular and sometimes it didn't. But that is really the only way I know how to do the job, is to really just try to help people. And even if that means delivering unpopular opinions or taking a new look at things like valuation, and really try to do the job from that perspective. I would say in terms of events, one thing I've been talking about a lot lately is how I started in the business right as the tech bubble was imploding, shortly after the peak. I think I got my job offer in maybe March of 2000 and started that summer, and then moved over to Credit Suisse shortly after the crisis in 2010. But I viewed those as big mile markers for the stock market. And what I remember is that each of those eras was different from the previous one, and there were different rules of thumb you needed to follow. Sectors acted differently. I've been talking about that a lot since COVID, and really comparing the period we're in now as the early post-COVID era of investing. That's going to be very different from the post-GFC era of investing, and very different from the post-tech bubble era of investing. And I think just understanding that things change when you have these big, enormous breaks in the market. Not everything is the same as it was in the prior cycle. And I think that's really, as I talk to clients these last few months, that's where I feel like my thinking is very differentiated versus some of my peers right now, is I really am looking for what are the new rules of the road? How are things different? Does your post-2010 playbook still work? Maybe it doesn't. Maybe you need to think about things in a new way.
Well, it's really interesting. You bring up your start in the industry during the tech bubble, and there's certainly some comparison in terms of the common narrative around valuations being stretched, especially at the very top of the S&P with the Mag 7, and that being compared to the tech bubble. But surely there are significant differences. I would love for you to frame out what you see as similar to that period, and then what is different from what makes the comparisons of 2024 to, let's say, 99 and 2000 different.
So if you think about some of the similarities. And I would say, well, maybe let's tackle the differences first. So if you think about 1999, 2000 versus today, I would say one thing that's just very different is I think the overvaluation when the Mag 7 or the top names, whatever cohort you want to pick, I do think it's been justified. If you look at differences in earnings growth expectations, you look at the actual earnings growth for 2023, it was just an enormous advantage in the Mag 7 versus the rest of the market. That merited a premium valuation. So the top 10 names, slightly more expansive bucket, has been trading around 27 times. The rest of the market's been trading around 16 times. But when you look at the differences in long-term earnings growth expectations or recent earnings growth actuals, it certainly seems merited. And so the silliness that we saw back in the late 99 period just isn't there. There's a rationality. And when I think about the Mag 7 bucket, what I've seen in sort of late 2023, early 2024, there's a Darwinistic attack on that bucket. And if your long-term growth profile is holding up, or there's something amiss in your earnings expectations, or otherwise in your fundamental story, you're getting kicked out of the bucket. So I see a very, very rational, shrewd investor base. And yes, we have resulted in some excessive valuations, but perhaps they're just much more deserved than they were in the past. In terms of similarities, and I think this is the post-crisis period, but what I remember about 02, 03, and I had been in the business a few years at that point, was we had that initial drop, the market rebounded, and then we entered into this just two-year period of funk or malaise. There was just a complete loss of confidence. It was like the investment community had gotten knocked down and just couldn't get back up. And there was obviously a midterm election. Politics had just become contentious. Remember, we had the lack of sort of resolution to the 2000 election that sort of rocked people in late 2000. So divisive politics were out there. There was geopolitical angst from the Iraq war. That was a big, big event for people, caused a lot of nervousness post 9/11 for obvious reasons. I just remember people were constantly afraid of tipping into a recession that never occurred. I started thinking about that probably at some point in 2022, present day era. And we actually put together a chart that showed, and I think through late last year, there was some 80-ish% correlation between how the stock market traded from 2022 to 2023 and 0203, if you picked sort of the early year highs and looked at the daily trading. And that just got me thinking about it more and more. I thought about this a bit at the end of last year as well, when people were putting out their year ahead outlooks. I had one client who said to me, the bears are recycling the same old arguments. I said, well, this is what happens after these crises. People just consistently underestimate the economy. They're constantly afraid of tipping into the abyss, and they're constantly worried about the recession that never comes. And I just started talking about that more with people late last year. And I find the number of investors I'm speaking with at least are coming to the same conclusion that after these big crises, confidence just gets shaken. There's some collective PTSD in the investment community and the forecasting community. And it takes a while for people to understand that things really will be okay and are not on the precipice of blowing up again. So that's, to me, is sort of one similarity. And I think having that understanding and that view of where we are, I would say, has definitely evolved in the last year and a half, but it is something I've been thinking about for quite a bit. Last year, I was not constructive enough on the market, but I was more constructive than many of my peers. And I think having that understanding of the psychology was something that really helped me keep a clear head as we navigated markets.
You mentioned the top down versus bottom up and this effort to listen to, let's say, folks who have expertise in the verticals and playing a role in aggregating what you're seeing there from the bottom up, and then combining that with maybe an assessment of the impact of inflation or the trajectory of monetary policy. You also mentioned having your team read transcripts. I'd love for you to just talk about what that recent exercise has yielded in terms of insights on the health of corporations and specifically, let's say, along the sector lines.
In terms of reading through the transcripts, it's interesting. I felt like there was a period last year, may have been the 3Q reporting season, where we just weren't learning all that much. And I was pretty frustrated, pretty annoyed, frankly, that me and my team had been reading so much and just didn't feel like we were learning anything. But I do think it got better since then. And this last reporting season, it was interesting. I felt like companies were making a concerted effort to talk down expectations. And of course, there's going to be an exception for a company here and there, but there was no smoking gun in terms of the demand environment is really falling off. I wasn't really seeing evidence that a recession is at hand. or really that we were anywhere near one. And I think that's been the case for quite some time. I was, however, though, seeing an intense focus on costs. And we only read S&P companies, 500 companies. I don't have time to read the Russell 2000 ones as much as I would love to. I just think that awareness of the cost pressures that companies were still complaining about didn't really rattle me too much when we got a couple of hot inflation reports recently, because I felt like we'd been prepared for that. I think the other thing I've noticed, if you look at the consumer conversation, and this has really been consistent for the last year or so, but the high end does seem to be holding up very well. The cracks are seen more on the lower end. And I'm not trying to dismiss those as not being serious, but the engine of the economy, the upper income earners, the middle class earners do continue. They seem to be continuing to spend on the things they want to spend. They are being pickier. They are being choosier. They are being selective, but they're being rational, not panicky. And I feel like that is a consistent theme that I've seen really over the last year. And maybe it's intensified a little bit in terms of the pickiness and the choosiness. I felt like that was very, very stable in terms of recent months based on what I was seeing in the company commentary. The other thing I've noticed, companies really have developed a confidence or an ego. I don't mean ego in a bad way, but I just think there's this understanding that they have managed through so many different crises since 2018. Whenever these new issues come up in the market or in the economy, they take it in stride. And I think that confidence very much comes through in the earnings calls. And so you can go back, say, to 2018, right when you had the trade war. And that did seem to rattle companies at the time, but we've thrown a lot at corporate America since then, from COVID to the supply chain crisis to the inflation shock. And I remember reading after SVB, we went back and my banks team was really taking the lead in terms of managing the conversation about that around here. I was more in listening mode. But really, I read through a lot of the 8Ks and press releases that companies put out. And that confidence was just really apparent. I saw so many companies alluding to their experience during the financial crisis or some other crisis and how they just swung into action and took care of things. And I feel like I see that come through time and time again in terms of these earnings calls. And how does that feed into market outlooks? Well, it's one of the reasons why we're not having a recession, is that companies have more levers to pull and they have a confidence that they can go in and preserve margins and cut costs or work around whatever issue is out there without having to cut bodies. That's one of the later levers that they pull now. And I think that was probably less true in past cycles. So to me, that work is very, very helpful in terms of challenging some of the groupthink that's out there about how necessary a recession has to be.
It's really interesting the way you frame it. You go back 5 years, as you said, companies have been through a boot camp around responding to and managing through crisis. You said trade war, supply chain, the SVB shock, Russia, Ukraine, and the shock to crude, at least for a period of time, rates, and of course, the lockdown itself in 2020. It's a tremendous exercise in having to have a plan and a backup plan to get through these periods. That's a really interesting way of framing it. I wanted to talk a little bit about the relationship between the earnings yield and the S&P, which is part of your chart deck, and the level of rates. You've outlined that rolling differential between S&P earnings yield and the level of rates, which of course is around zero right now. It's certainly been higher before. One of the things I think in 2022 that a lot of folks were asking themselves was, what's the right PE ratio for the S&P in a 5% rate world, having come through a 0 to 1% rate world for so long in that post-GFC period? A lot of folks said, well, the multiple should be higher because rates are so low and inflation is so low. How should we think about that, the comparison of the earnings yield of the S&P to the level of rates now?
I think there's a lot we can unpack there. So if I think about the basic earnings yield gap analysis, this was something that came up a lot last year. I didn't feel particularly bullish, but people kept telling me I was bullish because I wasn't bearish. But I think one of the things that sort of the more bearish part of the investment community was focused on was that collapse of the earnings yield gap between the earnings yield based on the forward PE and the 10-year treasury yield. I'm not a cross-asset strategist. I think back to those days when I interviewed with the bond people at Lehman, and the bond market is just not where I belong. I'm an equity person through and through. But I got pulled into this discussion enough that we just ran some numbers. And I should say I'm very quantitative. I didn't go to business school. I didn't take the CFA. I'm good at learning new things, but I don't have the traditional training. And so when a topic like this comes up, what do? I go and I run the numbers. I don't take what people are saying as conventional wisdom and assume that it's true. I go out and find what the data is telling me. And so that's what we did with this earnings yield gap analysis, and went in, looked at it, and I'm like, oh, okay, it is collapsing. That's a very different environment that we've been in since the post GFC world. Okay, I get it. This is very, very different. But let's just do a back test. What does this actually mean for stock market performance going forward? And it turns out, and I do things on ranges, and when you're sort of the range that we've been in recently, stock market's up about 12.8% on average over the next 12 months. That is literally what the data says. And we don't have fantastic historical data on this. It really goes back to the late 80s. So really what we have to look at the 90s, and I wasn't around in the 90s, I was in high school and college, but what I see on the data is that the stock market did just fine. We had the mid-cycle slowdown, we had a recession, the garden variety recession everyone talks about at the beginning. I looked at that as things are overdone in terms of the bearishness just based on that one indicator. If I think about the PE, I would say I tackle that from a slightly different way. And this goes back to my just sort of willingness to look at the world a little bit differently, not the way everyone always looks at it. I started getting questions in the summer of 2022 from investors. Well, if the PE is at X and if inflation is at X and the Fed is at Y, what should the PE be? And I said, well, I'm actually working on a little model. I was testing out PEs against different macro variables at the time, trying to come up with a model that would forecast. I said, I can run a stress test for you. Let me go look at that. And I had that conversation enough with people and did enough, sort of requests for people that we ended up putting a formal model together, publishing it, and really found that it resonated with people. Now, I'll tell you, some people hate this model. A lot of people think it's interesting. This model did steer us in a good direction last year. So what did we do? We have an average S&P PE time series that goes back to the 50s. We just built a very simple 4-variable regression with PCE as an input. We have Fed funds, the effective rate, then the target rate once it was available. We have 10-year treasury yields. So the model starts in 1962 because that's how far back I can get that data. And then eventually we put GDP in the model. GDP is not my favorite input in that model, but we started to get questions last summer. Can you flex this economic assumption? And so we added it in. What I love about the model is that it's not just post GFC. I feel like a lot of strategists are looking at averages back to 2010 or 2014, and this is the average, and this is the high and low end, and so this is what our target PE should be. Or maybe they're doing a regression on a forward PE with a 10-year treasury yield since 2010. And goes back to my idea of we are in a new era. We are at the beginning of a new era. We don't know if the 10-year is the dominant variable anymore. Maybe it's something else. Let's go back and look at history. I think my poli-sci background, my history background probably plays into this a bit, but let's go back and look at other cycles and see what we can learn from history that might inform what this new era is going to look like. And so we've built this model, and it's been telling us to look for trailing PEs in the low 20s based on where the street, not Lori, but based on where the street consensus thinks things like PCE and interest rates and the Fed are going to end up. And so we've just been plugging in consensus assumptions to this model, using the formula, having it spit out what the target PE is. And last year it was telling us to look for 21 to 22 times, which on my earnings number, which was pretty close to the street at the time, was looking for 47 to 4,800 on the S&P. What the model is telling you now, if you use consensus assumptions, is to look for about PE of a little over 23 times. And on my earnings number, that would take you to around 5,400 on the S&P. Now, I do think consensus numbers are probably a little bit stale right now and need to be adjusted a little bit when you're thinking about things like rates and inflation. So I ran a stress test over the weekend and just said, what if we keep interest rates flat? The Fed doesn't cut, 10 years stays where it is, which at the time we did this was about 4.3%. And we took inflation, we took PCE to the 4Q run rate of about 2.8%. That on my earnings number points you to about 5,000 on the S&P. On consensus earnings, I'm a little bit below consensus on earnings, takes you to about 5,200 on the S&P. And that's a range mid-March we've been hovering around in. We've broken it out a little bit recently. But I love the model because whenever there are just sets of assumptions that people get fixated on, like this stress test I just ran, been hearing the last month or so, oh my God, the economy's so hot, the Fed's never going to cut. I can run a model And it often will tell me why the market's getting stuck at a certain level if you buy into those assumptions, or where highs should be, where lows should be, if you want to put in different views of where the macro is headed. But I will tell you, Dean, the biggest difference I have with some of the other strategists around the street is a fair number of people who are looking for mid-teens PEs. And admittedly, they're probably doing their work on forward PEs, not trailing. I really do think they're taking too narrow of a view of history. And I think it's a little bit of a leap for some people to look at trailing PEs as opposed to forward PEs. But I do think switching the focus has served me well in the last year.
It's always uncertain as to what the beta, let's say, of one variable is going to be to another variable that we think logically or from an economic framework is going to drive the dependent variable. So something like rates and inflation, or rates and economic growth, rates and the PE profile of the S&P. And so that's certainly been a head scratcher for folks. And so I'd love first for you to just talk about how you think about how interest rates impact the S&P at large, maybe on a sector basis as well. You've done a lot of work on energy. That's an attractive sector from your perspective for a number of reasons. So maybe we can talk about that. And then I would also love to talk about your work on balance sheets and the maturity profile of debt. And so the opener is just walk us through your framework for thinking about the interaction between the level of rates, the trajectory of rates in the S&P, or just the sectors within it.
It's a complicated question. And I would say, I do think in general, companies are just less sensitive to short-term rates than they've been in the past. We see this with all these balance sheet charts that we put together. Companies have shifted more to long-term debt, really reduced their short-term debt. For the typical S&P 500 company, your weighted average maturity is 8.5 years. And the effective interest rate that they're paying on the debt they currently have is creeping up a little bit, but it's still near historical lows. And by the way, everything I just told you, almost all of it's true for Russell 2000 companies. Small cap companies, the only major difference. Obviously, the levels are a bit worse than what you have in large. This cleaning up of the balance sheets and the recalibration is very similar. And the weighted average maturity there is about 4.3 years right now. When I tell people that stat, it blows their minds. People have this vision of small caps headed off a maturity cliff. It's just not true. So I think in general, corporate America really did put in some important buffers that allowed them to weather this interest rate increase very, very quickly, or very, very well. I do think, putting the valuation issue aside, I think that interest rates falling, I think it just gets very, very complicated when we think about sectors. So you mentioned energy. I think that is one sector that looks very different than it did, say, 10 years ago. It has one of the best dividend yields in the S&P 500 relative to other sectors. It also has a much higher dividend yield than what it's had in the past. If you talk to our analysts, they'll tell you they've really cleaned up their balance sheets and look much better from that perspective. So I think that this is a sector, when we're looking at the S&P, that has a very low level generally of companies with dividend yields in excess of the 10-year treasury yields. It's a little bit harder for the income-seeking investor to find things to buy. I think the energy sector stands out in a very good way, and in a very different way than it might have in past cycles. So I don't know that you can just go back and look at all the history and make a conclusion. I think there's some very unique things about that sector now that do make it very appealing, given where rates are. I think the other thing that I noticed on energy recently, we have an overweight on it. We were debating whether or not to keep that overweight on to start the year, because generally our worldview was interest rates are going to fall. The economy is going to continue to do well. We'll probably see some rotation in the market. But energy is not always a sector that do well when interest rates are falling. If you look at the data since 2010, you basically see energy as one of the sectors that tends to outperform a bit when interest rates are rising rather than falling. We had enough things that we liked about the sector. It's cheap. You have that dividend yield appeal. My analysts are very constructive on the sector relative to analysts in other sectors at RBC. That's based on a quarterly survey I do of the analysts. And we looked at it. We said, okay, we're going to overlook that interest rate sensitivity. And then we thought about it a little bit more. And we said, you know what? The way the Fed conversation is just swinging and the way the inflation conversation is swinging, I like the idea of having a little bit of an inflation hedge sitting in my portfolio. And we felt like if the inflation fears came back, you'd see some rate fears come back to the market, and energy would be one of those places you'd want to be in. And we'll see how that works going forward. But I will say it feels like it served us pretty well throughout March, because energy has been one of the better sectors. if you look since the end of January. There's also obviously some geopolitical tailwinds or issues that are pushing that sector up a bit right now. But that really is a good example, I would say, of all the different things we think about when we make our sector overweights. And I do think that dividend yield appeal just really speaks to the competition of stocks versus bonds, but you can find some pockets of equities that will give you that yield.
Well, you've got one chart in your deck, I think that you're alluding to, which I've used some version of myself. You're pointing to the relative performance of each sector to the S&P, and it's that the correlation of that relative performance to the 10-year. And I think what's so interesting is you've got the positive correlations, i.e. higher rates outperformance for sectors like energy, materials, financials. And then you've got the other side, which maybe it's consumer discretionary, the obvious ones like utilities and real estate. And so there's sort of some implicit, almost self-hedging component of the S&P where you get this diversification to this macro factor of interest rates.
It's a great point. We actually upgraded consumer discretionary. We had been underweight before. That underweight didn't work out so well, but we pulled it up at the end of last year. And I remember talking to someone who was bearish on the consumer fundamentals. And I just said, look, if the Fed really is going to cut next year, if we get any kind of improvement in rates, I said, you don't want to be underweight the sector. That's dangerous. And maybe there's a little bit of an inherent conflict, right, between being overweight energy and pulling that one up when they're on opposite sides of the same chart. But I think what I've learned over the years, and I do lots of studies like this, consumer sentiment versus sector performance, inflation expectations, ISM, we do these for a lot of different economic variables. What I've learned is that you can't just sort of make your whole portfolio on one side of the chart or the other, because strategists, as much as anybody else, can get sucked into the vortex and consensus thinking. And if something like, say, ISM is falling and you haven't seen it turn around yet, you could sit there and you can say, okay, I'm just going to put on all these trades while it's falling. When it inflects, you're not going to be able to turn fast enough. Or if you sit here and you're watching it looks like it's in the depths of despair and you want to be a contrarian and try to pick the trade, that inflection may take longer than you anticipate to play out. So I think you have to be aware of these issues. But we've just never been the strategist that said, well, I think interest rates are falling, therefore I'm only going to buy the stuff on the right hand or the left-hand side of the chart.
You've pointed to this observation that post the SVB debacle, March of 2023, the leadership of the S&P has been aligned with movements in the 10-year yield. And of course, that leadership has become more and more concentrated over the last, let's say, year, certainly led by NVIDIA and led by an explosiveness in earnings as well. Just give us the big picture of how you think about this very top-heavy S&P. What observations do you have? Are there a particular set of concerns or opportunities that emerge from something that's so top-heavy?
I don't think there's anything inherently that should worry us about having a top-heavy market. I understand if something goes wrong. I understand the math. But we have actually gone back and looked at spikes in concentration and from a market cap perspective. And what you tend to see is that they're associated with periods of nervousness in the market and stress. But sometimes those spikes occur in the middle of the stress. Sometimes they occur before the stress, and sometimes they occur after the stress. And I still view us as an after the stress period. So I'm not sure. I've seen enough times when it's continued and times when it's reversed. I just don't think there's any clear signal there. I will say, if you look at the top 10 names in the S&P 500 from a valuation perspective, and you look at the PE, and that PE is bumping up against levels that have marked the high in the recent past. So I do think we're at sort of a natural pressure reevaluation point. If you look at the PE, the rest of the market, it's got room to run to past highs. So I see the data. It looks to me like there's a catch-up trade in the rest of the market that could potentially happen. I think we talked about the earnings growth advantage of mega caps before. If you look at the Mag 7 and their 2023 earnings growth, it was just by far dominant relative to the rest of the market. But if you look at, Bloomberg's got some great data on this. If you look at 2024, the S&P, the rest of the market, ex the Mag 7 is expected to flip from negative to positive earnings growth. The Mag 7 is expected to decelerate. And then if you look in 2025, Mag 7 further decelerates and rest of S&P further improves. And so the gap between those two buckets is only about 3%. It was close to 40% in 2023. So I see a shrinking earnings growth premium between the Mag 7 and the rest of the market. And I think that earnings growth premium in the past merited the premium valuations, but that rationale is fading. And I think as economic growth expectations continue to pick up, I mean, we've already seen GDP forecasts for 2024 move up from, I think, around 1% to start the year, 1.6% mid-February. They're 2.1% now. We're starting to see those move up very, very quickly. And I think as economic growth expectations continue to improve, it's going to help the denominator in that equation. It's going to help the earnings growth for the rest of the market, which is a little bit more cyclically exposed. So I think that we're going to get some rotation in the market as the rest of the market makes more of an earnings growth case for itself, which I think is a byproduct of the improving economic backdrop. And I do think you've got expensive valuations. You've got some crowding in the space. If you look at CFTC data and the NASDAQ 100 futures positioning on the buy side, you hit new highs. That's starting at the time we're recording this, at least, that's starting to fall off pretty sharply. So I think that we're very much seeing the seeds of rotation, but I think it may take a little bit more time to play out. I think that earnings growth advantage disappearing may have to become a little bit more apparent to people before we can really see it shift. I do think last year, the better balance sheets at the Mag 7 helped them out. I think that fueled a lot of the trade in the fall.
One of the things you point out too is this pattern with respect to how the market prices earnings expectations, that we start the year with a lofty view of earnings. We spend the first 2 quarters of the year marking those down a little bit, and then we stabilize. I just was hoping you could talk a little bit more about that and frame out what you think the implications are as we get closer to the middle point of the year.
It's great you bring that up. It's one of my favorite charts in the deck right now. And we put that together last year. There was this view in the market out there that earnings growth expectations were too high. They were going to have to come down. That was going to cause a big pullback in the market. And I'll tell you, in late 2022, I originally subscribed to that theory as well. But then I started digging into it a little bit more. And we realized we had a different chart that basically showed us that earnings revisions bottomed a couple of quarters. There was a big difference between that and the stock prices. So we see the stock prices bottom first, and then 2 quarters, the earnings revisions would bottom later. And so we looked at that and we're like, okay, there's something to this. Let's dig into it a little bit more. And so we put together those charts that basically show you that if you look at the summer of the prior year, you see downgrades in the second half of the prior year to the forecast. And then you get those downgrades again in 1Q and 2Q. And they basically stabilize starting in June. If you look at the S&P 600 for the small caps, it stabilizes a little later, but it's more like July or August. So that was a lesson to us last year. We actually reversed our view a little bit, just got into the more constructive camp because we said, you know what, we think the stock market has probably already put in its low and the earnings downgrades are going to continue for a little bit longer, but that's normal. And we think they'll be washed out by mid-year. So I think that helped us get on the right track with our market call last year. As we think about it today, again, go back to this 4Q reporting season we just went through, I really do think companies were trying to talk expectations down a bit, or at least keep them in check. We didn't see big downward revisions to the numbers, but I do think companies are very carefully managing the outlooks now. And by the time you get to the middle of the year, you've only got 2 quarters. I think most companies can make it through 2 quarters. And if you can't, then you've got bigger problems than the quarter. And so I think that as a strategist, I don't necessarily want to fight what the bottom up stock pickers are telling me about the earnings outlook for 3Q and 4Q, because they're much closer to the companies. They really understand how to read those tea leaves from the companies. And I think you just get a bit more certainty when you get to the back half of the year about what your earnings outlook is.
I would say on balance, as I listen to your outlook, it's reasonably constructive. You've got end user demand holding up pretty well. Valuations can be stretched in certain pockets, but in a lot of ways justified by just sizzling earnings growth. You've talked about the debt maturity profile and the companies taking the opportunity, as did the US homeowner, to restructure their debt at very, very low rates and buying themselves plenty of time. If you were to put on your nervous hat and talk about the things that you're less sanguine about, the things that you think could go wrong, what does that look like?
The one that probably keeps me up at night the most is just the geopolitical backdrop. Fortunate that I work with Halima Croft, who's really the expert on those issues. But I think back very much to 2022 and really the fall that preceded, she was very early in sort of calling the conflict in Russia and Ukraine and really trying to tell people like Russia is going to invade when nobody believed her. We saw markets really get hit and really had a bit of a scramble. I think that markets do not price geopolitical risk in advance. We have one chart that looks back at World War II. Even after you had the official declaration of war, the market went down a little bit. It didn't go down a lot. It wasn't really till Hitler invaded France that you saw parabolic, whatever the reverse of parabolic is, you just saw a sharp, immediate downward drop in the market in a massive way. And those two events, looking at that history of World War II, watching what Halima went through in 2022, I do think we're just not prepared if things deteriorate too much on the geopolitical front. And I think it's just not possible for markets to really deal with that ahead of time. So I worry about that a lot. I do worry about the fact that our sentiment models right now are sending a yellowish signal, the other's flashing red. So looking at the CFTC data, you're basically on buy side positioning on US equity futures. You're basically back to the highs that we saw in early 2018, early 2020, pre-COVID. You're above the highs we saw in 2021 and 2022. If I look at AAII, it's not as bad. We're one standard deviation above the long-term average, not two, but we are at levels that are consistent with a short-term pullback in the market and less than trend gains over the next 12 months. So I feel like on both those sentiment gauges, I'm seeing that the market is vulnerable to bad news if we get it. I have a more difficult time outside of the geopolitics telling you what that bad news could be. I do worry a little bit at the end of the year about the US election. We saw back in 2000 that the market did not get its usual post-election pop because we really didn't have resolution on the outcome. It had to get kicked up to the Supreme Court. So I do worry. This is more of a tail event, but I do worry if there's not a clear resolution on the US election, that's something that could be difficult for markets to deal with. So that's admittedly pretty far off.
The list of geopolitical uncertainties is a long one. And I think, as you're implying, they generally don't materialize. And it really takes the materialization of them for the market to react. So I'll just give you a quick summary of what we see in the options market. You look at global equity indices, crude, gold, FX implied volatilities, rates vol has come down a lot. These are all in extremely, extremely low percentiles, and they should be because the markets really are pretty well behaved. The event has to happen, I think, for the market to ultimately react. They don't tend to be all that forward looking in a lot of ways. A lot of what you and your team are doing is responding to requests from the clients of RBC, and the interaction with you and the clients, I think, inspires a lot of the work. Some theme that we touched on is just the difference in markets today versus, let's say, the post-GFC period where rates got really low. And it was just a very different way of thinking about markets. I was just hoping you could talk to us a little bit about how the client demand for your time and research is different now or has changed over the past couple of years in this higher rate environment.
There's always been an aspect of being a strategist, and I think this is true of people on the sell side generally. They want to know what other people are thinking. They want to know what the zeitgeist is. They want to know what the questions are asking. And I think in a sell side role, you have to be very careful to respect your client's privacy while at the same time sort of providing that service of what the zeitgeist is out there. So I feel like that's much more important than it's necessarily been in the past. Just that, how are people feeling? What are people thinking about? As opposed to doing projects for people. I think the buy side rather has started to do a lot of their own in-house quantitative analysis. So I think there's a bit less of that than what we've seen in the past. And there's a little bit more of just getting the color and the things that you can't get out of the Bloomberg or the FactSet or the quant tool.
I want to finish our conversation, which I've thoroughly enjoyed, Lori, by noting that you and your colleague Halima have been named 2 of Barron's 100 most influential women in U.S. finance. So that's not a small bit of recognition. So congratulations. That's fantastic and well done. Tell us about the state of the state with respect to efforts to further and empower the career development of females in this industry of finance. It's a very male-dominated industry. That's been that way for a long time. But certainly there's been initiatives at firms like RBC and just in the broader financial community to try to empower the growth of female careers. I'd love to get your perspective on that as a woman of prominence in the industry.
I will say, I feel like I've been very lucky throughout my career that I've worked for people, for the most part, who have been very supportive of my career. If I think back to Tobias, I was 27 years old or something when he told me I was going to be, I think he basically just told me I was going to be the small cap strategist. I don't think it was really a question, but I think back to how young I was, then would end up, he's no longer with us, but I remember talking to Jack Laporte, who was one of the great small cap investors of all time, and the fact that he even took the time to talk to me. But I think having those kinds of sponsors, not just a mentor, but a sponsor who's going to say, push you a little and say, like, you need to be in this role, and pushing an institution to put you in a role. I think that personally has probably been the most impactful thing to me. I think also the last few years, it's been a tough few years in society, definitely getting better on the upswing. I'm the mom of two small kids, a 3-year-old and an 8-year-old. I had a COVID baby. And just having people, I know she's been on your podcast before, Amy Wu Silverman, our derivative strategist, Halima, Elsa Linos, who's our FX strategist, having other senior women who have been going through the same sorts of things and are doing the same sorts of jobs, having people like that to talk to for advice and just to set an example for you, for me, I think is extremely important. All the mentoring programs that are out there, the senior women need support as well. So I think having sponsors, I think having those mentorship programs is extremely helpful. I think sometimes it can be peer-to-peer. I don't think it always has to be senior to junior. I've also gotten very inspired by some of the younger women that I've worked with over the years and leaned on them for support. So I think doing things where you can really just push women into new roles so they can be there to be trailblazers and to set examples and to be those peer mentors, I think those things are extremely important. And I think things like this list, giving people concrete examples of someone who may look a little bit different or think a little bit differently or be different than the person who's traditionally in a role. I think it's important to have those visuals for managers, for executives, and for people who might be thinking about doing those jobs. I think just having those examples that are tangible that they can see, I think are very important.
That's great to hear. So plenty of progress behind us, but plenty of progress in front of us as well. And I think the message is keep at it. A lot of this stuff is working, but it's certainly going to take some time. But it's great to hear folks like you so engaged in the process. And congrats again on the Barron's recognition. Lori, thanks so much for your time. It's been great to have you on the podcast. I've enjoyed learning more about your framework and your process and hearing what you think about markets in the here and now. So thanks again.
Well, thanks for having me. I really enjoyed it.
You've been listening to the Alpha Exchange. If you've enjoyed the show, please do tell a friend. And before we leave, I wanted to invite you to drop us some feedback, as we aim to utilize these conversations to contribute to the investment community's understanding of risk. Your input is valuable and provides direction on where we should focus. Please email us at feedback@alphaexchangepodcast.com. Thanks again, and catch you next time.